Good afternoon. It is the afternoon. It's just gone 12 o'clock. I'm Alec Hogg, and with me, my colleague based in Cape Town, Stuart Lohman.
Yes, Alec, as always, good to be here. Our nice little monthly ritual, as they say.
Yeah, it's been going on for well, today I had to calculate it for the compound annual growth of the portfolio. 7 years and 7 months. If you work it out exactly, it was 7.59 was the compounded figure that I had to work by. So 7 years, 7 months, which is also good luck because we've had 3 pretty difficult months that we've spoken about on the webinar here for, well, this year. It's been a really tough tough performance year for shares, particularly exponential shares, and that's where we have most of our investments in the United States. But before we get into this month's update, Stuart will take us through all the tech.
Thanks, Alec. I see there are a few high fives already, so I think some of the people know the routine. But for those new to the webinar, on the right-hand side of your screen, there's a control panel, and there's a little high five button. If you can see Alec and myself on screen and hear my voice with a little presentation underneath, you can just give us a high five so we know that's going through loud and clear. Oh, there we go, Alec. I've got some high fives coming through. Always good. And we do like to keep it conversational. Alex runs through his presentation, but on that same control panel, there's a little question mark. If you please put your question in there, I'll pass it on to Alec as we go along. But Alec, over to you.
Brilliant. Let's just double check because I've now switched the microphone to this big microphone rather than the computer microphone. Does it sound better?
I think it's a bit it's got not as clear, to be honest, Alec.
Okay, let's try that. How does that sound? Is that a bit better now?
It's the same. Yeah.
Oh my goodness. Okay, well, let's go back to where we were on the Mac microphone, and I can get rid of this one, I think. Yeah. How does that sound?
I think that's clearer, yeah.
Okay, so that just tells you why we have Apple as our biggest stock in the portfolio, because it's even better than working through those big microphones. But I think it's more a question of user error than anything to do with the road cost. I'm sure we'll get that all sorted out in due course. But if you have a look there, the WebTrader portfolio is now, it's 7.59 years, but we keep it at 7.5 years. Compound annual growth rate of just under 14% in dollars, just under 20% in rand. Those are excellent figures, but of course it's very difficult when you're in a falling market to even hold on to that. We did have a very good month in the month of July, after having 3 really bad months before. That has now turned around, and as we go into the presentation today, you'll see that things are looking a lot better. In fact, that's the good slide to start with. The portfolio value went up 8% in the month, helped by a weaker rand and an improvement on Wall Street. You see the JSE All Share Index actually was down, and that's reflected in one of the recent purchases that we made there. Remember, we switched out of Avenge and went into Transaction Capital and ABSA. ABSA's done really well. In fact, both ABSA and Transaction Capital doing even better today. So if we played around a little bit with the numbers and used the latest share prices, that'd look even better. But as you can see there, the NASDAQ was up 2.2, which is primarily where we're invested. But the rand's decline gave us a good improvement in the portfolio for the past month. And well, we need it. We've had a pretty rough time. And there you can see how the portfolio has been performing post-pandemic. Fantastic. We bought in very aggressively there to some stocks that did very, very well for us. And however, since the peak there in November last year, the portfolio's values have been on a downward trend with a reversal in July, particularly this year, where we've seen 3 very bad, well, very sharply declining months, and then the reversal in July, which hopefully isn't like what we saw. You'll recall that it looked a little bit better in March, but then it quickly proceeded to continue losing for the next 3 months. it doesn't look like that's going to be a repeat situation, and I'll tell you about that why. I'll tell you why in just a little while. Nice table though, isn't it, Stu? That graph, which shows exactly what the portfolio has done.
Not quite the Table Mountain, Alec, but at least it's got a bit more ups and downs, as they say.
Yeah, I didn't look at it that way. A really good, strong improvement after the pandemic hit, and that was when you needed to keep your nerve. And then it's come back, but only about halfway to pre-pandemic levels, and that's I think you would have bought that. Most people would have bought that in 2020. And there's the portfolio in detail. And as you can see, we have a large holding in Apple and Amazon. Now, some people would say, why are you so heavily invested in those two? There's a reason for it. What we do with this portfolio is when we make the investment, we think about it long and hard before making the investment, and then actually follow Warren Buffett's approach of holding on forever. So our average time of holding is forever, but until such time as there is a change in the fundamentals of the business. And until there's a change in the fundamentals of Apple and Amazon, we won't be touching those shareholdings. We do not believe in taking profits. We believe in riding our winners. And you can see a similar thing with Purple Capital. Purple's done very well for us, but it was doing even better when it was sitting at R3.50. There was a temptation at the time to take some profit, and perhaps some people would have, but for us, we're in there for an average holding period of forever. That also gives you some comfort on both Spotify and Xero, brilliant companies, both of them, moving into a market segment where they dominate, and in the early stages of being able to capture the rest of the world on that one. So although they're down by more than a third in Rand terms since the purchase of those two stocks in 2021, they are still very comfortable holds in the portfolio. And you can see for the rest, recent acquisitions, Palantir's done really well, Meta not quite as well, and then Transaction Capital and Absa, similar thing, with one going up last month and the other one going down. But the real point to have a look at there is at the bottom. We started this portfolio with $200,000. It's now $530,000, and that is in 7.5 years. Helped along a lot by the Rand. That was the whole intention, was to find a way of protecting ourselves against the South African Rand's decline. And we started there with a Rand at 11.27 Rand. It's now 16.73 Rand. Oops. Okay, and you can see in the last month, the Rand weakening from 15.84 to 16.73. In fact, got as high as 17.20 at one point, but the last few days it's picked up again, primarily because of the strong dollar initially against the Rand, and in the most recent few days there is a different philosophy that seems to be coming through now about the dollar. The dollar index is still very close to 20-year highs. It has been boosted there by the change in the interest rate cycle in the United States. Individual stock performances. What I've always do here is to show you the month-on-month performance, and as you can see, there have been some pretty big months for Apple and Amazon, our two biggest holdings, hence the 8% increase. That increase, by the way, is in US dollar terms, which is interestingly enough. Both of those done really well. Xero, which is listed in Australia, is also up 8.5%. Purple Capital, as mentioned earlier, you could almost telegraph that. I had a really interesting interview with Charles Savage, which is worth watching. It's on BizNews TV on YouTube, on exactly what's going on with Purple Capital at the moment. He is restructuring, or the business has been restructured away from a high growth focus to one of investing more heavily now in the existing customers, and they've got 1.5 million customers that they can harvest, if you like, by giving those customers a wider range of products. It's a fantastic company, Purple Capital, and it certainly has now achieved scale through easy equities. Then we have a look at Palantir, which was up a little bit in the past month. Transaction Capital, which we bought into a month ago, down 4%, which means if you didn't buy a month ago, good time to buy now. And then Absa, which is already starting to run, thanks to Corky Koyman for putting us into that stock at that time. And then overall, the portfolio, it's very difficult now to compare Rand dollar with the stocks that are held there, because many of them have only been added to the portfolio quite a long time after the starting point of the Rand dollar. But it is still indicative that the big three, Amazon, Apple, and Microsoft, have done far better for us by being invested in those stocks than had we just put the money into a US dollar account, which was really what the story was right from the outset. And there's a graphical indication of the individual stocks. Again, you have those big three, Amazon, Apple, Microsoft. They have come back a long way in the last few months, but they're still way outperforming the Rand dollar exchange rate, or the alternative of cash, over the past 7 years. And then the Shift portfolio. This is the one that we started in December. And what I've done here is to just show you the impact of the Rand. So there's the portfolio. Quite nice to see Amazon and Palantir, which is 25% of the portfolio already. Those two doing well, in fact, in front. Then the Invesco QQQ, that's the exchange traded fund. So what the idea is that we will be reducing or lightening the Invesco holding as we find good options to invest into. Apple has done better, a lot better than the market generally. Microsoft pretty much in line with the market generally. You can see the QQQ is the NASDAQ, what's happened to the NASDAQ index. And remember, what we did here was we bought 3 installments of $10,000 each. And then the wild cards are the ones that have really hurt in this portfolio. And you can see them all. Cloudflare, my favorite share, actually, the Bitcoin ETF, a very small holding in Bitcoin through the Bitcoin ETF or Pro Shares, and through MicroStrategy. MicroStrategy is actually the world's biggest business intelligence listed intelligence company. But its appeal to us was that it was trading at a discount to a substantial holding that it has in Bitcoin. In fact, it trades at a little bit like Naspers and Prosus used to do with a holding to Tencent. MicroStrategy traded at a big discount to its holding in Bitcoin. And we've got 2% of the portfolio in Bitcoin, and you can see how badly Bitcoin has done by the performance of that part of the portfolio. But even Pete Viljoen says you should have a little holding in Bitcoin or cryptocurrency, because it is something that is either going to rocket in the future or perhaps wouldn't do that well, but still it's a bit of insurance to have in your portfolio. So the wild cards, not so good. My favorite stock, Cloudflare, also not so good. We will be, oh, my apologies, someone from the United States wants to phone. I don't know how that came through, but what I shall do now to make sure that my very fancy Apple computer doesn't link up to the iPhone, I've just switched my iPhone off so that we won't get that interruption again. But you can see there that Cloudflare down 51%. I'm really looking forward to the financial results from that company, which are coming out next Thursday after the market closes. I'll get into a little bit more of that in a moment. In fact, let's do that now. Just to remind you that you can, this is an interactive discussion. So you can post your questions anytime, and then Stuart will interrupt. And perhaps today, what I'll try to do is get through the presentation in 15 minutes, and then we can talk individually on the questions, and I'll go through all the notes that I've done, all the research that I've done as the questions come through. Stuart?
Thanks, Alec. There's one question that touches on a stock you mentioned, Prosus. GP just wants to know if you've any change in your view around that stock.
Yeah, what I suggested last month was that they now have access to a treasure chest, really, where they can sell their 10-cent holdings at any point in time and buy back the shares in Process and reduce that discount. So if we had Process in the portfolio, I certainly wouldn't be selling it right now. We sold Process and Naspers. In fact, we had Naspers, not Process. We sold Naspers because of the stuff that was going on in China at the time. And I'm still not terribly excited about China and about the way that the Communist Party has got its tentacles into the Chinese companies. But Tencent is holding its value for the moment, and it probably will not fall too much further and give Naspers and Prosus the opportunity to realize the capital that it has there. There's no more cap on them selling. You might recall that they had a deal with Tencent where they would only sell 2 percentage points of their holding over a period and then wait for 3 years. Well, that's all done now. They can sell those shares anytime they want to. And our mistake here was actually just ignoring that at some point in time, the Naspers stroke Prosus management would come to their senses, and they certainly have, and now they're unlocking value in a way that just makes a whole lot of sense. So I wouldn't be investing in Chinese shares still. To me, there's just too much risk there by massive government interference. And we actually saw that today. I'm not sure if you followed, but Alibaba came out with an announcement this morning that it's moving its primary listing to Hong Kong. Alibaba was listed on the New York Stock Exchange in 2014, and the discussions that have been going on between US regulators and Chinese regulators over Chinese stocks could end up with 250 Chinese shares being delisted on the American markets. And the reason for that is that the Chinese regulators don't like the American regulators don't like Chinese accounting. They want to be able to get into the books of the companies that are listed on the American markets because they feel that the Chinese accounting is not accurate, certainly not accurate according to the Western side. So one has to bear that in mind, and there's all kinds of the whole structure of Tencent as well, of the way that you hold your shareholding is something to bear in mind too. But for the moment, that's fully discounted in the Prosus and Naspers price. And while Prosus and Naspers can sell their shares in that, it's like treasure chest, take that back, buy back their own shares, then those stocks will be pretty well supported.
Thanks, Alec. You mentioned the Rand. Sean just wants to know, the weak Rand has been to South Africa's advantage. What's the likelihood of the Rand strengthening in a global inflationary environment and pressure on big tech earnings?
Yeah, it's an interesting time that we're in, and thanks, Sean, for opening the door for me there. I had a really, really good interview with Kevin Lings, the chief economist at Stanley. But what I like about Kevin is, first of all, not only is he really bright, but he works for Stanley, which is an investment house. So he keeps a finger on the pulse on economic data that really matters, that affects the investments. And he came in on Friday after being at the South African Reserve Bank, and he mentioned that the reserve banks, the central banks around the world, talk to each other continuously. The guys here will be talking to the chaps at the Fed, and they'll be talking to the guys at the Bank of England and the European Central Bank all the time. So the guys in Pretoria are fully aware of the reason why certain things are done in the US. And Kevin, and they clearly shared part of this with Kevin, and Kevin came back and said, the whole strategy of the Federal Reserve is to front end the interest rate increases to get inflation under control quickly. In other words, go sharply with your interest rate increases, get inflation under control, and then you can start cutting interest rates and stimulating the economy again around about middle of next year. And there was a story in the Wall Street Journal this morning that I referred to or linked to in the premium newsletter, which articulates exactly the same thing that Kevin was saying. So it's almost like Kevin was ahead of the game, and anybody who watched the interview here at BizNews on Friday was ahead of the game. There were some pretty caustic comments about, what does he know and what's he talking about and why is he making this up? He wasn't doing any of that. He's very well informed. And Kevin was actually saying that he could see the inflation rate coming down from 9.1% in America, which is at a 40-year high, down to 2% in a year's time. And obviously, with the inflation rate at 2%, there's no need to increase interest rates to kill the economy. You can actually do the opposite. And already there are people on Wall Street who are making that bet. So that translates to good news for shares, but bringing it back to the Rand, Sean, the Rand has been very, very weak as a consequence, most recently that is, as a consequence of the dollar being at a 20-year high, the dollar index, and that's the basket of currencies against which the dollar is measured. With interest rates not rising any further and anticipation that interest rates in America will actually start falling soon, that could have the negative or the opposite impact on the US dollar, which would then mean, all other things being equal, that the Rand would be firmer. However, and this is a big however, the Rand has been stimulated by high commodity prices. And high commodity prices are not a guarantee for the immediate future. So you've got all these different moving parts. And that's why I feel that if we have to make an investment in US dollars because of all the moving parts and because it's so difficult to call, we like to do it over a 3-month period. And it's exactly what you can see here on the Shift portfolio. The first investment was made on the 14th of December, and that cost 159,000, call it 160,000 Rand. The second investment cost 152,500 Rand, and the third investment 151,000 Rand. So add it all together, and the investment there is 463,000. Take the current Rand rate, because that is weaker than where we were when we made the investment, and the decline in the worst bear market that many of us will probably, well, I can't say many of us will ever see, but it certainly is the worst bear market in a long, long time. This portfolio is down less than 20% because of the benefit that we've had from the Rand. Are we expecting that the Rand will strengthen? You've got to be a very brave person to say that. It has picked up a little bit in the most recent days, but when you look into the future, you look at our economy and our mismanagement of the economy, and the fact that we've been bailed out by high commodity prices, which may not continue into the future, then you have to say, Warren Buffett would say that goes into the box that's too tough to call.
Thanks, Alec. Andrew just wants to know, he says, are there any stocks that would be a good investment sort of as today for 5 years' time? Because obviously these were bought 6 to 4 months ago. He's asking if there's anything that sticks out for you. Yeah,
I would say pretty much all of the shares that we invested in this portfolio, the BizNews Share Portfolio. I like the Shift portfolio, but remember we've got some wild cards in there. And wildcards are by their nature companies that could either go spectacularly right or spectacularly wrong. And we took a decision that we would have some wildcards in that portfolio to begin with. But maybe let's just look through this portfolio. If you're taking a 5-year view, there isn't one here that I wouldn't be happy holding for 5 years. Not one of these shares. Zero does stand out. Absa Group. Corky Koyman keeps telling us that banking shares are the biggest beneficiaries on higher interest rates. Now, you've got to be careful, I suppose, if you're doing a cyclical play, because if interest rates go higher and then come back again, as is being suggested could happen in the United States, and of course we would follow them as well in South Africa, then that benefit would not necessarily be a long-term one. But what I do like about Absa Group is they've got new management, the very good management for the first time in many, many years. And those managers, certainly Corky says he has a very high regard for them. and those managers are likely to add to the alpha, or in other words, the outperformance of ABSA. It'd be very hard to underperform from the way they have underperformed in recent times. So it's from a pretty low base, but that would give me a little bit more courage about ABSA. Transaction Capital is a really good company as well. They focused on high stigma industries or sectors, and what that means is there is almost a social unhappiness with the sectors that they're in, which is taxis, debt collection, and second-hand cars. When you look at those from the outside, you also have to realize that there are good operators in that area, and Transaction Capital has the blue chips in those generally stigmatized sectors. So that's another good one as well. Also controlled by 3 unbelievable entrepreneurs, very low profile people, but guys that really know what they're doing. Meta Platforms, I love that one, and particularly in a 5-year play, because they are the dominant player in virtual reality. Having tasted a little bit of virtual reality, I've still got a lot more work to do in that area. I can see why Mark Zuckerberg has got so excited about it. Palantir is made for difficult times. It is difficult times at the moment. It's still trading below the IPO price of $10. So you're able to buy into that company at a very, very good value. And the world has got better for them as well. Xero, I spoke about that a bit earlier. In Australia, that's the best online accounting software. Spotify are benefiting from the expansion now of podcasts. We see it here at BizNews. Our podcast operations have just rocketed. And thank you very much to everybody for supporting us in that way. And we'll keep giving you great audio to consume. The whole media on demand, and we see it in YouTube as well, where we've now got comfortably the biggest business online or video on demand option. You go and check the numbers between BizNews and the competitors on YouTube, and you'll see what I'm not exaggerating here, but those are the 2 fastest growing areas in media. It's video on demand, i.e. YouTube, and audio on demand, i.e. Spotify. And audiences are moving away from by appointment in media, which is when you sit watching television and just consume what you're given by the television station, the network station, or indeed radio is the same thing, to switch on your radio and listen to whatever that station feels that it should be supplying you, rather than making your own choices. So Spotify is the dominant player in podcasts. We've spoken about Purple Capital, Microsoft, Amazon, and Apple are bankers. Yeah, I'd be happy to buy any of those on a 5-year bet.
Thanks. Alec Vanessa just says, what's your view on shares like Renergen and Thungela at this current point in time, given last night's pledges to renewables, etc.?
Renergen is not a company I know well, so I'll pass on that one. Thungela, it's had a phenomenal run. It's a 10-bagger since it was spun off from Anglo American, and you might recall at the time we slipped up a little because we were very keen on it. The last time Anglo American spun off the last time a big mining company spun off its South African operations because it was being pressured into doing it by non-economic players or for non-economic reasons, was when Sibanye was spun off from Goldfields. And look at the incredible success story that has been. So we were very keen on Thungela, not because we had any insights into where the coal price would go, but because it generally was a big corporate that was being pressured by social or ESG factors, which now the whole world is seeing it was overdone. The pendulum swung far, far too much towards environmental, social, and governance factors, that whole ESG story. In fact, if you wanted to lose money, if you wanted to get an underperformance, just go and buy one of those ESG funds that the financial services industry provided with alacrity. because when there's a fashion, financial services guys are pretty smart, and they knew exactly how to make money out of it. Anyway, Thungela has been a 10-bagger, and now you've got to look at it perhaps with very different eyes. But the coal price has rocketed over the past few months, indeed, from an already high level, and it doesn't look like it's going to be going down anytime soon. As it's priced in US dollars, as a rand hedge, Thungela is in a very good place. And what we're seeing in Europe is not the aggressive move towards renewables that we did see in the past on just normal economic factors. The Russians have cut back the gas stream to 20% of what it was. And as a result, the Europeans are importing as much coal as they can get their hands on to get power stations converted and to get the energy equation back into some kind of a balance, having given up on coal in favor of gas, and particularly Russian gas. So as long as the Russian sanctions continue, you can expect that the coal price is not going to be falling anytime soon.
I suppose that's also good for the SA economy, Alec, the coal demand. But
fantastic for our economy, Stu. We should not underestimate it. We forget that coal is our biggest export earner by some distance. We also earn a lot from iron ore, which has done pretty well, and platinum. But coal's the big one.
Just to shift to Netflix, Alec, Mike just wants to know, how do you feel about it after its Q2 results?
Well, I feel relieved that Netflix isn't that bad a company, but I'm also very happy not to be invested in it, because Netflix itself, the management itself, themselves, were not aware of the story they told us was that the move to video on demand and streaming was in an early stage. And as a consequence of that, there was plenty of room for everyone to play there. And then come December, when those quarterlies came out, they said, oops, sorry, we do need to worry now about competition. And then the March figures came out and they went backwards and had a bad forecast. And now the most recent figures to June, the June quarter, when they came out, they lost ground. They lost 1 million subscribers. Now, if you're an exponential company, you don't go backwards. And I like what Sean Pesh says about Netflix. He says it's still priced as an exponential company, still sitting at $80 billion market cap. So with competitors like Amazon Prime, and Apple Plus, and of course HBO, which in our country we get through MultiChoice. HBO is the bigger one. It's always been the big one in that field. Netflix, because it's separately listed, gets more attention. But HBO is Game of Thrones, all of it's really the big one. With Amazon slowly but surely making ground, they spent a multiple of what was invested in Game of Thrones, which up to that point was the biggest investment ever in a series, on a new series which hits in September on Lord of the Rings. And that is likely to attract the kind of attention to Amazon Prime that might have been missing, or certainly to the video side, that might have been missing up to now, in the same way that you'd expect when you have a big hit. Netflix did really well, for instance, out of its Squid Game. But in this game, in that field, in streaming, it's all about content, and it's all about having really top-class content. And Netflix has been accused of becoming terribly woke, which is, read Helen Ziller's book, Go Woke, Go Broke. They've got good programming, but the great programming is not always produced by Netflix itself. And if you have a look at Apple Plus, for instance, they've had some of the biggest hits in this game, in this field rather. You've got to keep the hits coming. So what would worry me right now about Netflix is not the fact that maybe the share price went down too far, which some people are saying, and hence it's not quite as bad as we thought it was. So it's up 14–15% from the results. But what's coming down the line? And when Amazon Prime launches its Lord of the Rings, it's likely, if it's anything half as good as what's been said, and certainly from the investment that you're talking about there, that there's only going to be one loser, and that's Netflix. So yeah, I'm happy to be out of it.
Thanks, Alec. Harville says you constantly refer to Cloudflare as your favorite share. He just wants to know why. You mentioned things like, is it profitable, generating free cash flow, undervalued relative to this, etc., etc.
Yeah, it's Cloudflare's results are coming out next Thursday, and I think we'll know a lot more. It grows at 50% a year. It is the dominant player in internet security, and like Palantir, a beneficiary of the more dangerous world that we're going into. I'm looking forward to seeing whether it can continue the 50% growth rate that it has achieved consistently over the last few years. It being the dominant player in the field, charging a very modest fee for internet security. I think we pay $20, and then when we do have a tax, we can immediately up it. And so it's almost like you pay a retainer, and then when you get these denial of service attacks, which happen all the time because people, whether it's governments or whether it's companies that you're criticizing, in the corporate space, I guess it would be competitors, industrial espionage. You need security on your website, and Cloudflare is the go-to place for security, web security. So the cash flows are good. They very close to they were close to break even. They're investing more. They've got new projects now, so they'll show a small loss per share. But these are not. It's like Google in the early days when Google was losing money every year. The question was, is it adequately funded, and is it growing so that can it deliver profits as well? I'd suggest go and read a little bit more about Cloudflare. I love that company because I'm in the business. We're in the business, and I just think that they've got an irresistible offering. Would someone buy them out? Oh, I hope not, because the potential for Cloudflare is still vast. But you know, when you're looking at companies like Apple that have got hundreds of millions of dollars, billions of dollars rather, in cash sitting around, and perhaps one day they might see Cloudflare as a juicy acquisition. If they were to sell, it would be at a massive premium to the current share price. Thanks,
Alec. It's not something I encounter often on this webinar, but I've got no questions, so I'm just trying.
Well, that's good. That means that we have satisfied everybody's thoughts. I'll just go through quickly what's coming up in the quarterlies. Apple's results are out on, well, let's start with the first one. Meta's results are out tomorrow. You've got to have a look on that one for the impact of the Apple app tracking transparency. What's happened there is that Apple has now allowed us to track third-party apps, and that has really hurt the digital advertising efforts of particularly Google and Facebook, who dominate. They dominate. They've got like over 50%, well over 50% of the world's digital online advertising. So it'll be interesting to see where Meta comes on that side. How badly has it affected them? Snap came out with results last week, which were really badly impacted by it. And so there's been extrapolation that we'll have a similar situation with Meta. But Meta's not in the portfolio because of digital advertising today. Meta's in the portfolio because of the potential of virtual reality tomorrow. So just remember that. When the share price comes under pressure, you're not buying it on today's results, you're buying it on the future numbers. About 40% of Meta's revenues come from digital advertising. So I'm really interested in seeing. They come out tomorrow after the market's closed. Tonight we have Microsoft's numbers. The shares are down 23% year to date, but the numbers tonight will give us a much better look at how corporate spending is going in America. Microsoft gets a little bit of advertising, but they haven't really been a player in the online publishing area. However, they are huge in software, and corporates love Microsoft, whether it's Teams or Windows or Office. We'll get a good feeling on how the recession is starting to bite in the United States and elsewhere as well. The street's expecting revenues of $52.5 billion, and that's going to be, if it overshoots that, then Microsoft will probably, the shares will probably go up. Of course, if it's below that and the recession has been biting worse than anticipated, then you can expect some problems there. Apple results out on Thursday. That's our biggest stock after the market close, so we'll only pick it up on Friday morning. Year to date, the shares are down 13.5% as against the S&P at 16.5%, so it's actually outperformed the market generally. The company has got a really good record of beating what the street expects. 19 of the last 20 quarterlies, Apple has beaten the consensus projection. There's some interesting things to look out for there. Their new products that have come through. The iPhone 13, I've got one, there it is, but I haven't got the top end, which is the one with the 3 cameras. I've only got the one with the 2 cameras. But what they've done with iPhone 13, which is really interesting for the first time, is they've given a wide range. So you can get an iPhone 13 for $699 or over $1,000. So that's a new strategy that they're trying, and it'll be interesting to see how that's worked out. Also in these results, we'll get the initial indications of 2 big products that they've got a lot of hope for, the new MacBook Air and the new MacBook Pro, which are laptop computers with a new chip. Apple introduced its own chips. It used to have Intel chips. It's now got its own M2 chip, and it has made a vast improvement to the performance of its products. Be interesting to see if the market is agreeing with that as well. Apple Plus also there, especially for Netflix fans, you'll see how that has been progressing. Again, the story I was talking about a moment ago with Amazon, Apple Plus is also moving quite aggressively into the video field, the same field that Netflix is in, and they've actually just signed up Major League Baseball in the United States, which is expected to give the Apple Plus subscriptions a little bit of a boost. Amazon, incidentally, have gone for Champions League football from 2024. You'll be able to watch that on Amazon. They've got 20 Premier League, English Premier League games that they've signed up, which they have exclusive broadcasting rights for the current season. And they've even gone into rugby. They now own the rights to the autumn series when the Springboks go over to the UK and play against England, Ireland, Scotland, Wales. Those matches will only be on Amazon. So see, this is why you got to worry about Netflix, because when Amazon and Apple, for whom their on-demand, their streaming services are an add-on, when they start getting into that market, they can comfortably outbid a streaming-only service like Netflix. So it's quite tough competition. And as we know from DSTV in South Africa, well, certainly myself and many people I know are subscribed to MultiChoice, not for anything else excepting the live sport that we can get on it. On to Amazon itself, the earnings release is on Thursday. Last night, we had a shock from Walmart. The numbers were a lot worse than expected. In aftermarket, Walmart was down by 10%. That also pushed Amazon's price down by 4% in aftermarket. So there's quite a lot to watch out for there on Amazon. They've increased the Prime subscriptions in the UK because of inflation from £7.99 to £8.99. The first increase that they've done in that market since 2014. And they are, however, investing quite heavily on Amazon Prime, and it'll be interesting to see how that is growing or is anticipated to grow. Also, the market's really marked them down quite a lot. Amazon shares are down 26% this year in the year to date. So one of the concerns there is that they hired too many workers during the pandemic, and now they have to lay them off, or they're holding on to too many people, too many workers at the moment. Spotify's results come out tomorrow, just before the opening bell. So we'll have those. That's the US opening bell. We'll have those for you in Thursday's newsletter. Consensus there is that they'll be up 6% year on year, which is pretty good if you consider that the fallout there was over the whole affair with Joe Rogan and Neil Young. Joni Mitchell then went on to Neil Young's side as well, where they were encouraging musicians to cancel with Spotify. There was a bit of a knock, but most sensible people said this too shall pass, and so it has. There is an expected loss there of about 68 cents per share, which is up on a year ago, but it's well capitalized, so no problems there with Spotify. And for the rest, Cloudflare I did mention coming out next Thursday. Uber next earnings release is on Tuesday. That's a week from now, where it's expected to continue to show very, very robust sales growth in the 70% level, and that makes it a real exponential company. And then MicroStrategy results are out on the same day, next Tuesday, but it's a tiny little holding that we have in the Shift portfolio. So that pretty much wraps up what you need to look out for in the next few weeks of earnings season. Stu?
Thanks, Alec. Just on the Shift portfolio, Brian wants to know, if you did have spare cash, what would you bring something new in, or would you top up on anything you're currently holding?
That's a good question. I'd top up on Cloudflare, most definitely. And I think Palantir is now in a good state. You know, we've got 10% there. If anything, I would maybe try and get that up to 15% if there was spare cash. But I'm not obsessive about it at the moment. I'm waiting for those results, and once I've had the chance to read through their results, they're coming out on Monday the 8th, and again the revenue growth is expected to be around 25%, so the exponentiality continues. But I'll be looking at those results very carefully and reading through them. I really like the company. I really like that company. Actually, the two, Cloudflare and Palantir, are the two that, in my opinion, are undervalued relative to where they are today. Meta, quite a few things have got to come right for Meta. The virtual reality has got to come through there, and the other wild cards. 2U has got an offer on the table of $15 from an Indian company, but we know what happened with Twitter. Offers come and go and don't necessarily get consummated. So I'd be cautious there. Uber's had, although it's still growing very rapidly, it's had its problem with media recently with an expose about how it operated, in particular in New York City. So there's a bit of a smell there. And then Zoom, not growing as fast as it was in the past, and maybe one to be a little more cautious about. But the top three, I'm always happy to hold those and to add to them: Apple, Microsoft, Amazon.
Thanks, Alec. You mentioned earlier the release of results post and pre-market. I see, in South Africa you really only get pre. Is there anything to read in that, or is it just giving analysts more time, or they're just spreading out the delivery of them? Because obviously they do quarterlies and there's a lot more companies listed.
I think the pre-market would be from the European companies. Post-market is the norm in America. Mostly the American companies want to give analysts an opportunity to read, to attend the quarterly earnings calls, and to actually have a chance to I mean, these are massive organizations now, and there's a heck of a lot that needs to be assessed in the results. But the pre-market, which is what happens here in South Africa, because although same thing, you would get, in the old days, the results used to be released in the morning newspapers. Of course, that's now become archaic, but there's still a lot of companies in South Africa who do release their results only after the market's closed. I don't think you can read anything into it.
Sean just wants to know if you've ever heard of a company called Datadog. I'm not sure if you've heard of Datadog and if you have any views there. I haven't heard of it either.
Not one that's crossed my radar, Sean. Sorry. Datadog.
And just a follow-up. A follow-up, he just wants to know if you have any views on where the euro might be heading. I'm not sure that's in our scope, but he just wants to know with the US and euro parity, they're 1-to-1.
Well, I think the broad comment there goes back to what Kevin Lings was talking to us about, and what's happening in America at the moment with the Fed. Remember, as interest rates were rising, it made it more appealing to own dollars or to hold US dollars. And so with interest rates continuing to rise, as that cycle continues, it's going to support the dollar. It has to, because if you're in a currency like the Rand, where you might be getting, say, 8%, and you can get 4% in a low risk currency like the dollar, you probably would switch it across. So that's the all other things being equal kind of scenario. As long as the interest rate cycle is growing, people are going to be buying or holding their money, their currency in the source of value, or the place where money goes when it's risky. And remember, we're in a risky world. Also, the United States is just so much better structured, the economy, than the European economy. And with the Ukraine-Russia war adding even more concerns to what's going on in Europe, you've got to be cautious on that one. But longer term, the dollar is at 20-year highs. And if you were taking maybe a 5-year bet, euro versus dollar, I suppose the sensible thing would be to say nothing goes up forever in a straight line. Perhaps there would be an ability of some kind of a readjustment there. But if you were taking a 50-year bet, surely you'd be saying the economy that's going to do best is the one that is best structured. And the dollar is the world's reserve currency, certainly at the moment. And as long as it remains that way, they can misbehave, as they have been doing, in creating dollars through things like quantitative easing and now all the money that was created by the Democrats during COVID, and get away with it. It's like the rest of the world is just giving their money to the Americans, and the Americans can misbehave and push that into their economy. Forget the ethics of it. The reality is the US economy benefits from that. So it becomes a bit of a self-fulfilling function. But these are big questions that Nobel Prize winners spend their time thinking about. And from our side, we just got to watch. Just got to watch when the big trends change, and maybe to be also more sensible by investing in things we really do understand and know, and that's the companies we have in our portfolios, and of which we are co-owners.
Thanks, Alec. Follow up from Sean. You just want to know if you have any stocks on your radar for next generation capacity, things like 5G, 6G, or Starlink, etc.
Outside my circle of competence, but it is something that when I do see stuff on that, I do like reading about it. I love trying to understand new technology. I'm reading this incredible book called Engines That Move Markets. It's really probably the best investment book I've ever read, and it's going back to the major changes during the ages. Starts in canals, for instance, and how canals transformed the UK to begin with. Everything used to be transported in the UK on horse and cart, and then suddenly you had canals which would take much bigger, well, not suddenly, but they then invested heavily in canals, and these were all companies. Back then, interestingly enough, if you wanted to register a company, it had to go through Parliament. It was an act of Parliament to register a company. But then, so there was lots of corruption. But canals, and then it went to railroads. Railroads in the UK, canals then in the US, and then the US railroads, and it goes all the way through to the internet. And in every instance, it's much easier, the author explains, and he was the head of investment research at Templeton. He explains that in every instance, it's easier to find the losers than the winners. So to try and pick the winners of a new technology, especially if you're investing in an individual share, is incredibly difficult. The idea, I suppose, is go with an ETF if you find a new trend that you really like, and maybe invest in an ETF themed one. But there's a big opportunity in picking the losers, and you can see it in my own industry. The obvious loser of the internet was newspapers and magazines. It's obvious. We still have newspapers, they still exist, but they're a shadow of what they were. I'm also seeing it now with radio, where you get radio on demand. Same thing with network television. So it's an obvious lose. It's obvious, and when you're in a losing sector, it's terribly difficult to buck the trend. Whereas it's just as hard to find winners, or who the winners are, out of the many hundreds of car companies that started when there was a move across to it. So that would be my caution on that one. From the history, it tells you very, very hard. And that's why Meta is quite a big bet for us, because we used to say Meta are going to be the winner in virtual reality. They're certainly investing heavily in it. And they're a bit like the Tesla of virtual reality. Tesla dominant in electric cars, but there's no guarantee that they're going to be the winner there. So it is a bit of a bet.
Sean just wants to know, can you repeat the title, Alec, of the book again?
Engines That Move Markets. I ordered it on Amazon. It took a little while to get here. It's only in hardcover, but it is a absolutely superb book. I'm only early stages into it. I've learned more from this book than most investment books that I've read. Really, really good book. I'll try and get some exclusive books to order some and bring them down to the conference in the Berg. And for those of you who haven't booked yet for the conference, we're now full up, and there is a waiting list. But there is a lot of accommodation in the valley. We unfortunately can't recommend anywhere because we haven't been to all of the places. But I suggest that what you do is come to the conference, wherever you might be staying. All you need is a bed, and there are enough beds just to, outside where the hotel is, because the day pass, it's 100% access to everything that the delegates who've booked into the hotel have. The only difference is that they've got a bed at the hotel, and unfortunately with day passes we don't. Come March, we should have, we've already booked a whole bunch of chalets that we're going to make available for the overrun from those who can't get into the hotel. So that's on the resort itself. But this time around, being school holidays, those chalets are fully booked. So unfortunately, we haven't been able to access any of those. But do try and come to the conference. We've got Cy Jacobs coming for the first time. Piet Viljoen is back again. They're going to have a debate. Rob Hersov's there. R.W. Johnson. There's just so much that you'll take away. Charles Savage will be giving us an update on Purple Capital, so one of our portfolio stocks. There's a heck of a lot that you'll be able to take home from it. I think it's a great investment of 4 days.
Thanks, Alec. Looks like we've come to the top of the hour. Julian just got a comment. He says you can get it instantly on Kindle, Engines That Move Markets, if you do.
Of course. But Julian, the way I read a book, and I might be old-fashioned, I like to take a pencil and I like to write in the side and underline things, so that when I remember something, I can go back quite quickly and look through it. Of course, you'll tell me that in Kindle, you can just put that in your search function and it pops up immediately. Yeah, you're right. Okay, but sometimes there are some things that old habits that die hard. But good point there. Thank you. You can get it immediately on Kindle.
Thanks, Alec. We're at the top of the hour, so I think we can leave it there. Thanks as always for your time and insights, Alex. It's my best hour of the month, as you know. I always say that, I must stop it, but yes, it's one of the most insightful. So thank you very much.
Well, it's great because we get an opportunity to share. The work that we do here at BizNews it's amazing. I get up early in the morning and produce the BizNews breakfast briefing. And to do that, you've got to read a lot. You've got to be in touch. And the newsletters, the premium newsletter, it doesn't write itself. So this portfolio is kind of a consolidation of a lot of those learnings. And I'm glad you enjoyed, Stu, and to our community, to our tribe. Thank you for your support. Thanks for making it a fun hour for us. And let's hope that we got more good news for you next month. Till then, I'm Alec Hogg. Cheerio.